Gold has always been a precious metal coveted by people for centuries. But gold isn't just a shiny object to look at, it's also a valuable asset to own. Hello and welcome to Finance Capital Advisory. In this video, we'll be discussing investing in gold, its history, benefits, and risks, and why is it a smart investment option for many investors. Gold has been considered a symbol of wealth and power throughout history. Ancient civilization used gold for many purposes, including decoration, jewelry, and currency. In ancient Egypt, gold was used to decorate tombs and temples, and it was also used as a currency for trading. The Greeks and Romans also used gold as a currency and for jewelry, and during the Middle Ages, gold coins were widely used as a currency in Europe. During the gold rush of the 19th century, gold was discovered in large quantities in California, which led to a boom in gold mining. This led to the creation of new gold currencies, and the United States adopted the gold standard in 1900, which meant that the value of the dollar was tied to the price of gold. However, in 1971, the United States ended the gold standard, which meant that the value of currency was no longer tied to the value of gold. Despite this, gold remains a valuable asset and it is still widely traded. Benefits of investing in gold. One of the primary benefits of investing in gold is its low correlation to other assets. This means that gold doesn't move in the same direction as other investments such as stocks and bonds. As a result, gold can be a valuable diversification tool for investors who are looking to reduce their portfolio's risk. Another benefit of investing in gold is its safe haven status. This means that it tends to increase in value during times of economic uncertainty. During times of inflation or currency devaluation, gold can act as a hedge against these risks. Gold is also a finite resource, which means that its supply is limited. As demand for gold increases, its value can also increase. This makes gold a valuable asset to own as part of a long-term investment strategy. There are several ways to invest in gold, including physical gold, gold ETFs, and gold mining stocks. Physical gold can be purchased in the form of coins or bars, but this can be costly and requires storage. Gold ETFs are an easier and more cost-effective way to invest in gold, as they are traded on stock exchanges and offer exposure to the price of gold. Gold mining stocks offer exposure to the gold mining industry, but they also come with additional risks such as operational and financial risks. Investors should consider their investment goals, risk tolerance, and investment time horizon when deciding which type of gold investment is right for them. While gold can be a valuable investment, it also comes with risks. One of the primary risks of investing in gold is its volatility. The price of gold can fluctuate rapidly, which can lead to significant losses for investors who are not prepared for this volatility. Investing in gold can also be expensive, especially when it comes to physical gold. Storage and insurance costs can add up over time, which can eat into returns. Additionally, gold does not generate any income, which means that investors cannot rely on dividends or interest payments to generate returns. Investors should also be aware of the risks associated with gold mining stocks, such as operational and financial risks. Gold mining stocks can be volatile, and they can be affected by factors such as geopolitical events, labor disputes, and natural disasters. The price of gold is influenced by various factors, including supply and demand, inflation, economic and geopolitical events, and the value of the US dollar. When the demand for gold exceeds its supply, the price of gold tends to increase and vice versa. Inflation can also influence the price of gold, as investors often turn to gold as a hedge against inflation. Economic and geopolitical events, such as changes in interest rates or political instability, can also affect the price of gold. Finally, the value of the US dollar can have a significant impact on the price of gold. When the US dollar weakens, the price of gold tends to increase as investors turn to gold as a hedge against currency devaluation. Investors should consider investing in gold as a part of diversified investment portfolio. The exact timing of when to invest in gold will depend on a variety of factors, including the investor's risk tolerance, investment goals, and the investment time horizon. Investors who who are looking to use gold as a hedge against economic uncertainty may want to consider investing in gold when they expect economic conditions to deteriorate. This could include times of high inflation, currency devaluation, or geopolitical instability. Investors who are looking to use gold as long-term investment may want to consider investing in gold on a regular basis, such as through a gold ETF or by purchasing physical gold on a regular basis. This can help to smooth out the volatility of the price of gold over time. Investors should also consider the tax implications of investing in gold. The tax treatment of gold investments can vary depending on the type of investment and the investor's country of residence. In the United States, for example, physical gold investments are subject to capital gains taxes when sold for a profit. Gold ETFs, on the other hand, are treated as stocks and are subject to capital gains taxes when sold for a profit. Investors should consult with a tax professional to understand the tax implications of investing in gold in their country of residence. Investors should be aware of common mistakes to avoid when investing in gold. One common mistake is investing too heavily in gold, which can lead to an over-concentration of risk in a single asset. Another mistake is investing in gold at the wrong time, such as when the price of gold is high and likely to fall in the short term. Investors should also be aware of the risks associated with gold mining stocks, and they should do their research before investing in these type of stocks. Finally, investors should be aware of scams and fraudulent schemes that target gold investors. These can include fake gold coins or bars, Ponzi schemes, and high-pressure sales tactics. While physical gold is a popular way to invest in gold, there are alternative ways to invest in gold without owning physical gold. These include investing in gold ETFs, gold mining stocks, and gold future contracts. Gold ETFs are a type of exchange-traded fund that tracks the price of gold. They are a convenient way to invest in the gold without the need to own physical gold. Gold ETFs offer investors the ability to buy and sell gold on an exchange, just like a stock. Gold mining stocks are another way to invest in gold. These are stocks of companies that mine gold or their precious metal. These are the stocks of companies that mine gold or other precious metals. The price of these stocks is often correlated with the price of gold, but they can also be affected by other factors such as the company's financial performance and management decisions. Finally, investors can also invest in gold future contracts. These are contracts that allow investors to buy or sell gold at a future date and price. Gold future contracts can be used to speculate on the price of gold or to hedge against price changes. How much to invest in gold? The amount of money investors should allocate to gold depends on their investment goals and risk tolerance. As a general rule, investors should not invest more than 5 to 10% of their investment portfolio in gold. Investors who are looking to use gold as a hedge against economic uncertainty may want to consider investing a higher percentage of their portfolio in gold. However, they should be aware of the risks associated with investing too heavily in a single asset. Investors who are interested in buying physical gold can do so through a variety of channels, including bullion dealers, online retailers, and banks. When buying physical gold, investors should be aware of the purity of the gold they are purchasing, as well as any additional fees or charges associated with the purchase. Investors should also consider the storage and insurance cost associated with owning physical gold. While selling physical gold, investors can do so through a variety of channels, including bullion dealers, pawn shops, and online retailers. Investors should be aware of the current market price of gold when selling, as well as any fees or charges associated with the sale. Investors should also consider the tax implications of selling gold for a profit. Investors should also be aware of the risks of gold investment scams. These scams often involve promises of high returns or exclusive access to gold reserves, but in reality, they are fraudulent schemes designed to steal money from unsuspecting investors. Investors should be wary of any investment opportunity that seems too good to be true and should thoroughly research any company or individual offering gold investment opportunities before investing any money. Investors should also be aware of the tax implications of investing in gold. Depending on the jurisdiction, gold investment may be subject to capital gains tax or other taxes. It is important for investors to understand the tax law in their jurisdiction and to consult with a tax professional before making any investment decision. Long-term outlook for gold. Despite the risks associated with investment in gold, many analysts believe that gold will continue to hold its value over the long term. Gold has been a store of value for thousands of years, and its limited supply and historical significance suggest that it will continue to hold value in the future. Additionally, global economic uncertainty and geopolitical risks are likely to continue, which could support the demand for gold as a safe haven asset. This could drive the price of gold high over the long term. Investing in gold can be a valuable addition to a well-diversified investment portfolio. It offers a hedge against economic uncertainty, diversification benefits, and a limited supply. However, investors should be aware of the risks and tax implications of investing in gold and avoid common mistakes such as overconcentration, investing at the wrong time, and falling for scams. By doing their research and consulting with a financial advisor, investors can make informed decisions about investing in gold and build a well-diversified investment portfolio that meets their investment goals and risk tolerance. Investing in gold is a popular investment strategy for many investors due to its historical significance, limited supply, and diversification benefits. However, investors should approach gold investments with caution, as there are risks and pitfalls associated with investing in this precious metal. By carefully considering the benefit and risks of investing in gold, researching investment opportunities thoroughly, and consulting with a financial advisor, investors can make informed decisions and build a well-diversified investment portfolio that meets their financial goals and risk tolerance. Ultimately, investing in gold can be a valuable addition to a well-diversified investment portfolio, but it is important to approach it with a clear understanding of its potential risks and benefits, and to make investment decisions based on a thoughtful analysis of one's individual financial situation, and investment goals. If you found this video helpful, be sure to like and subscribe to our channel for more informative videos on personal finance and banking. Don't forget to share this video with your family and friends who may also benefit from this information. Remember to always do your own research and consult with a financial advisor before making any major financial decisions. Thank you for watching, and we'll see you in the next video.